I'd love to talk to you about, some of the tax code impacting a purchase or impacting a sale, pre-tax versus post-tax dollars on an exit. Like any of that, I think from a strategic standpoint would be really cool to discuss.
Sure, and we can do that. In a sell side transaction, if the owner has engaged an investment banking firm, the investment banking firm will cover all types and kinds of transactions as part of the arrangement for the engagement, because the investment banker and the owner of the business really have no idea when they begin the process how this is all going to evolve. And if the investment banker is exclusive, meaning he's solely working on this project for some sort of a success fee, he's going to be pulling out, or she, all the stops in terms of exploring what is the highest and best transaction that can evolve for the company. And as I mentioned before, I always take a look at the consequences of the successor employees. Will the jobs be there? Will the factory be closed? Is the building going to be leased off to somebody else? Those are all factors, and the owner of the business is driving the bus. But we try and ask all the right questions so there's no surprises. If I bring in an offer and 30% of the workforce is going to be cut, maybe that's not such a great idea for the seller. On the other hand, he may say, if it's the best price, I'll take it. I don't care about the employees. I mean, it does happen. So you have to get all that aired out ahead of beginning a transaction. And then once you start, well, you're kind of out in the marketplace. Now, as to the tax consequences, it really depends on the currency that you're selling your company for. So are you selling your company for all cash at closing? Are you selling your company for stock in another company? Maybe your company will become a division of another company. Maybe you're selling it for cash and stock. Maybe you're carrying the note. Maybe you're selling it with seller financing, or maybe the loans you have in place are now assumed by the buyer. So let me give you an illustration of one transaction as an example. We had a company that went to the market to sell. They were open as to cash or stock. They sold the company, this aggregate of companies, it was a conglomerate of companies, for a negotiated number of shares in a much bigger company. So Justin, it was a stock for stock exchange. The tax consequence of a stock for stock exchange, essentially a cashless transaction, is there's no tax. The tax was deferred. Now the seller exchanged his stock for 9 million shares of the buyer's company. And it was a minority interest, and the stock was trading at $36 a share. So you can do the math on that. It's probably around $350 million. But there was no tax paid. So the entire value of the transaction was pre-tax. And as it turned out, that stock moved from $36 to $72. And it's just a
Wow.
coincidence that it topped off at exactly 2x the number. Now,
Wow.
did the family that held those 9 million shares sell at 36 or 38 or 42 or 51 or 72?
I'm
I don't know.
guessing not.
Well,
They
I mean,
they but I would
let's
take
say
some money off the table for sure.
let's say that they probably took some money off the table, and they would have paid at the then rate, long-term capital gains tax rate, as opposed to ordinary taxes. So, for example, just a sidebar for a moment, if they had taken some of that sale proceeds in the form of compensation on an employment agreement for the next 2 or 3 years, let's say $1 million a year for 3 years, that would be ordinary income.
That's right.
At that time, the tax would be almost 2x what it would have been at long-term capital gains rate at that time. But they put all the chips on the table and they said, we're out, you're in, we're now a division of your company and we're leaving the scene, and we'll take it all in stock. And it just happened to be that they got a 2x return, or as is said in the industry, a double bounce on their investment without a single dollar of tax paid. Now, if they had sold at $72 and actually top picked the market, which rarely anybody can do or should try, by the way, then they would have paid capital gains tax on the delta from their basis, which of course was very low. They were founders of the company, so there was practically no basis whatsoever, all the way up to 72. But as things go, Justin, the economy turns and moves, and that's why we have to think about global markets and put things
Yep.
in context, because we ran into the subprime market for mortgages in 2008, and that stock is $72 at that time was trading at $8 a share.
Oh my goodness.
So did they sell? Did they buy more? We don't know. But we have to take all those things into consideration when we're starting to put a transaction together, particularly a leverage transaction. We have to be very clear in our mind, what currencies would we take? If somebody needs cash and they need to get it over with and they have a higher and better use for it, they may not mind paying the tax and getting it over with so they have the cash to do the next deal. We work with many serial entrepreneurs who will rarely take equity in somebody else's company because they have no control.
Yep.
They'll trade
Yep.
their company out, they'll take the cash, they'll pay the tax, and now they're liquid, and they can apply that cash along with leverage to the next deal and the next deal and the next deal.